Thank you. Thank you very much, Mamta. And hello and welcome, everyone. I'm delighted that, we had, close to 350 registrations for this session. And I'm very excited to see the kind of interest that the warehousing sessions and the sector is seeing. This is our third event in this, in the series of investment platforms in real estate. The first one was in commercial real estate. The second we did for residential and developmental real estate. And this one is industrials, and probably the most promising yet fledgling sector, which is warehousing. I'm also delighted to have a very well-rounded panel with me. I have Rajesh Jaggi. He's Vice Chairman at Everstone, and obviously a very well-known figure and someone who very successfully developed indoor space of experience in real estate, and is every time we used to talk about warehousing, the only name that came about was Rajesh, because he started doing warehousing at a time when no one really understood that space. So I'm delighted to have Rajesh, and thank you so much for coming. Absolutely delighted. We have Vikas with us. Vikas is runs his family enterprise and is the director in Future Warehouse Solutions. They have close to $3 million, 3 million square feet of warehousing space, largely in the Northern India space, and he's been extremely influential on the policy front and is involved in the National Logistics Committee of FICCI and other industry bodies. And then I have with me my very dear friend from long, Rajeev Bairathi. Rajeev now runs an NBFC and investment advisory firm, but he was historically prior to this, heading the corporate finance for Knight Frank, a very influential name. He worked with Bharti Walmart and other, Reliance Group and many other large corporates. And even in his current role, is looking at warehousing very, very closely. Then amongst the two more important speakers from who drive the data and the policy again is Matthew Arenet. He's from ICRA, and I'm extremely thankful to Matthew for developing a presentation over the weekend at short notice for this warehousing space. And he asked me, what do you really want? And I told him that our audience is really more of the capital provider audience. And so the presentation should be orientated like that, of course. And there is tremendous interest from the perspective of, warehousing, how, where is the demand, what investment platforms, and I think he's done a phenomenal job. And I've always personally enjoyed the perspective of rating agencies. So I think this, generally I would like to start with giving a lot of statistics, but I'm going to hold myself on because Matthew will give you all the detailed statistics on that on a more realistic basis. So that's so that'll be Matthew. And finally, I think one of the bigger areas for warehousing sector, which I think is we are suffering, and one of the biggest concerns is around GST. And we have Kaustuv from PricewaterhouseCoopers. Kaustuv, interestingly, is a lawyer from National Law School, Bangalore, which is one of the most premium institutions. I remember Kaustuv, I applied for that test and could never get through. So I'm absolutely envious and delighted to have you here speaking on GST from PwC. With that very quick introductions, I think I would like to start the panel. And and maybe I've forgotten my very important colleague, Abhinav, who Harlalka, who leads our, who is a leader in the private equity M&A practice and also structured finance, and has been instrumental in developing a lot of the investment platforms across real estate, infrastructure, and also been advising a lot of Invits, both listed and unlisted. Abhinav will be speaking about foreign venture capital investments and how warehousing is important. And then how warehousing can be used by foreign venture capital investors, because, as you know, this is a specific route which gives tremendous agility to a foreign investor looking to invest in debt and equity, and it's only available for infrastructure sector, not for real estate. And so I think this is one element of warehousing that absolutely delights us, because it qualifies as infrastructure, which therefore opens the door for warehousing to foreign venture capital investors and the very liberal foreign venture capital investment regime. It also entitles itself all the significant tax benefits that were unleashed for sovereign wealth funds and pension funds. And it's an asset class that could also be rolled into Invit, the very new and the very popular new monetization regime for infrastructure assets. With that very quick introduction, I'll try and speak less, because we have detailed presentations and speakers on each of these topics. I'll quickly request Matthew to please run his presentation on the warehousing sector, which he has prepared at short notice, but in a very detailed manner.
Yeah. So good evening to all the participants on the call, and thank you to Ruchir for giving me this opportunity to share our views. And in this brief session, I intend to cover a broad overview of the industrial real estate sector, which has gained a lot of investor interest over the last 3 to 5 years. And I will touch upon the key growth drivers, the industry competitive landscape, the potential risk factors that we see, especially given the current turbulent environment. If you could move to the first slide, please. So the total stock of industrial real estate in the country is estimated to be over 200 million square feet. And the stock of available space has been increasing at a pace of over 20% compounded rate for the last 3 years. So this is due to a combination of increasing supply of modern warehousing facilities from all the industrial real estate platforms that have been set up. And this has been largely absorbed by various consumer industries, including e-commerce, third-party logistics service providers, who are looking to enhance their operational efficiency through the utilization of such modern warehousing facilities. The absorption of such warehousing facilities in 2019 was estimated to be over 35 million square feet, and this has continued to grow over the levels that were seen in the year 2018. The majority of the stock is concentrated in the cities of Delhi NCR, Mumbai, and Bangalore, with Kolkata, Pune, Chennai, Hyderabad, and Ahmedabad being the other preferred locations. The main tenants in the industrial park can be categorized into the following segments: third-party logistics service providers, e-commerce marketplaces, manufacturing companies, retail and FMCG companies, and other miscellaneous sectors, including cold storage chains. Among these, the highest share of absorption is attributable to third-party logistics providers and e-commerce marketplaces, which are estimated to contribute more than half of the demand. India's logistics real estate per capita is among the lowest in relation to other countries, and there is significant potential for the demand to increase in line with the economic growth, more widespread adoption of efficient logistics practices, and increasing urbanization. E-commerce in particular will be a strong growth driver, as India's per capita consumption is among the lowest among these peer countries, and can be expected to grow in line with our economic growth. Moreover, the trend of expanding share of online purchases in the overall retail basket will also support the growth prospects for e-commerce industry, and we expect this to be one of the main drivers even in the current environment. Third-party logistics service providers have also witnessed significant growth in their revenues, especially with the adoption of GST and the increasing benefits that they provide to companies which have facilities spread across the country. Coming to the industry structure, so the industrial real estate sector had earlier been fairly fragmented and dominated by independent developers or landlords. However, over the last few years, we are seeing a distinct shift towards consolidation. This has been done under the aegis of various industrial real estate platforms that have been set up. These platforms, in many cases, derive operational and technical support from a foreign operator who is able to bring in the global best practices and efficiency norms. And the capital is supported by institutional investors who have largely been in various pension funds such as CPVIB, CPDQ, and also private equity investors such as Yadav and Blackstone. These platforms in turn either develop greenfield assets by buying the land outright, or they acquire existing assets from independent developers and then undertake brownfield expansion on that. The total investment commitment by such platforms totals to more than $7 billion, and which in turn can support a development of more than 120 million square feet of industrial real estate assets, assuming some bit of leverage also. Of this, we estimate that about 20 million square feet has already been completed as on date, and the remaining would be developed over the coming medium to long term. We have put up a comparison of the portfolio under development by some of the largest Indian platforms, and we can see that notwithstanding the improvement in the scale of such platforms in the recent years, they are fairly, the scale remains low in relation to the large global operators who are operating in the APAC region, even adjusting for the fact that the Indian operators have a narrow country jurisdiction. So in this slide, we will look at some of the challenges and the risk factors that the industry is looking at. The most immediate challenge will be the COVID-related disruption, which would mean that there could be some deferment of planned leasing transactions until there is some stabilization of operations and companies are able to devote more time to their business expansion, because in the current environment they would mostly focus on the stabilization of the existing operations. We could also be looking at in the medium term some demand moderation from sectors such as auto and FMCG, given the overall weak economic outlook that is being projected in light of the COVID-related shutdown. These various sectors in turn may also affect the revenue growth for 3PL services, and that in turn could also impact the growth prospects for the 3PL operators. Nonetheless, amid this gloomy scenario in the near term, e-commerce continues to be a bright spot, and we could expect that they will continue to grow as the criticality of their operations have come to the forefront even during this COVID crisis. Another concern which could especially impact the sector could be that this problem of subdued demand may be compounded by the large supply of ongoing and upcoming development. So based on the committed capital, we could see that there is at least 100 million square feet of ongoing and upcoming development. And we have also put up a chart here which shows a comparison of the leasing status for completed SPVs that we have rated and also the under construction SPVs. And whereas the completed SPVs are operating at 90% plus occupancy, the under construction SPVs on an aggregate have about 40% pre-leasing status. And on an absolute basis, that consists to more than about 12 million square feet of unleased space. And this large upcoming supply may also create pressure on the occupancy level. Another challenge for the sector may be the rising land costs, which may constrain the return metrics for the various projects. Whereas over the last years, we've seen that the land costs have gone up given the high investor interest and the interest from various platforms to aggregate land. Whereas correspondingly, the rental rates may not have appreciated at the same pace. So possibly this could be one area of concern for the industry. And this could be particularly a vulnerable situation if in an environment of moderated demand and weak rentals, this may end up affecting the return metrics for the project. Just a summary of how our ratings work for the industrial real estate space, and we have largely the ratings are constituted on the triple sector category for the under construction projects. We do not. I think the ratings across all this portfolio is supported to some extent by the moderate leverage practice that we see in these industrial real estate platforms, with LTV normally in the range of 40 to 60%, and the ratings also derive support from the strong sponsor profile, and the fact that in this particular sector the implementation risks are fairly low, and there is a fast execution cycle wherein the boxes can be built anywhere between 6 to 12 months, depending on the pre-leasing that has been done. So with that, I end the presentation and hand the floor back to Ruchir. Thanks, Ruchir.
Thank you very much. This was very detailed and very crisp, and I think it will pretty much set out the basis for the discussions that happen now. Just before I move on to the more technical and the commercial questions, Abhinav, can I ask you to please put up that presentation and share your views, how you look at warehousing from an foreign investment and tax perspective?
I think while the presentation comes up, just to give a quick background, I think warehousing is a part of, is similar to any other investment mechanism for a large number of the routes that we have, be it the FDI, be it the FPI. The benefit, however, of warehousing is it falls under the infrastructure list. And accordingly, it is considered as infrastructure for FVCI, into which FVCI can. So FDI and FPI are two routes that we have generally for all sectors. So this remains as it is. FVCI is where it becomes a real game changer, honestly. And that is because of multiple reasons. One, the FVCI has the benefit of providing assured returns to investor, since pricing norms and pricing restrictions do not apply for investments by FVCI. So I think that is one very important aspect which provides a lot of comfort to the investors. This also links back to the point that put option and call options, which are not permitted at assured returns for other sectors, are permitted for the purpose of investment in warehousing. What this ultimately does is it gives investors downside protection and equity kickers as well. So one is, of course, your assured return concept. Apart from that, investors can invest, and this has been happening quite commonly now, a bulk of the investment coming in through the FVCI route, say through an OCD, which is an optionally convertible debenture, which is structured debt in a sense, which provides downside protection to the investors, since these are debentures but provide equity kickers where the redemption premium is linked to the underlying valuation of the company, or the in this case lease rentals, for example, or other business parameters, which provides investors equity kickers as well. And another important aspect is there is no cap on the interest or dividend from a regulatory perspective. There may be certain tax considerations which one must need to bear in mind, depending on how the investment is structured, whether it's a related party resulting in transfer pricing, or the interest deductibility because of the minimum capitalization norms. But I think apart from that, FVCI offers one of the most lucrative and the probably the best option for companies in India to raise money from, and for investors offshore, more importantly, to invest in the sector from. And this becomes very important because as we are discussing with investors, we've now realized that in sectors where Invits are permitted, which is the last item on this particular slide, investors who had historically taken a view that let's put money in the best possible manner at that particular point of time, but rolling it over into the Invit is becoming a challenge for them, and it's proving to be quite tax inefficient, even though the entire basis for the Invit is tax benefits. So we've seen now investors who are working across various infrastructure sectors, not particularly warehousing, wanting to structure the entire investment upfront with an outlook of monetizing the entire asset in the next 3 to 4 years by way of an Invit. And this is not just on the investor side, but even on the sponsor side, where we have controlling investors or control investors wanting to structure the investment upfront itself rather than doing it at the last stage. Yeah. So I think an Invit structure, we've just broadly put out how an Invit works and how the entire thing will be looked at. You have the sponsor who transfers the project into the Invit and in return gets units. You can have other investors, domestic and offshore, coming in to invest into the Invit as well. And the Invit, by way of the entire structure as proposed by SEBI, or as prescribed by SEBI rather, has an investment manager who's similar to an IM for a normal fund. You have a trustee sitting there, and you have a project manager who's providing project management services to the SPVs under the Invit. Now, I think the entire structure as such is, becoming more and more famous, because at the end of the day, it's a monetization strategy for the promoter, and it's also proving to be a extremely beneficial structuring vehicle for investors who are looking to acquire assets, be it a portfolio of road assets, be it a portfolio of other assets, through the Invit itself. And not just a portfolio, and Invit also provides you the opportunity of having a single asset Invit as long as the minimum parameters of the asset size and the issue size of 500 crore or 100 crore are met. What can go into an Invit are eligible infrastructure projects, which are defined to mean primarily projects where COD has been achieved wherever it's a PPP project, and wherever it's a non-PPP project where a lot of these warehousing entities will fall. As long as all approvals are in place, they will qualify as eligible infrastructure project. And Invit needs to have 80% of the assets to be eligible infra projects. So, what we've seen is that investors have started raising queries on if you have multiple warehouses, in some cases, even if it's a single large warehouse, can we roll them over into an Invit? And, is this going to work in the longer run? Now, I think this depends largely on what kind of a model are you looking at. Are you looking at a yield model, or are you looking at a growth model, which I think Ruchir will be discussing later. For yield models, this structure is becoming quite lucrative and quite helpful from a tax perspective as well, because it removes a lot of the tax ambiguities on whether the investors will, whether the Invit as a whole, as a entity in India, will be taxed or not. The large benefits that we've seen with foreign investors with Invits is the fact that at the end of the day, it's a structure which has a centralized governance at the Invit level itself. While yes, you have a different board and a KMP at each of the SPVs, all of them roll over into the Invit, and the Invit is a regulated entity with different entities involved, as it's seen in the slide deck. It's a structure itself, and each of them have their own responsibilities to SEBI and the investors, in some cases including being fiduciary responsibilities. So what we've seen, investors becoming a lot more comfortable with an Invit structure as opposed to a pure sponsor investment. Of course, not to say that the sponsor platforms are not there, but Invits is something that they're looking at more and more keenly now. With respect to benefits on the tax side, I think one is the fact that sovereign wealth funds and pension funds have now, under this recent year, under the recent budget, been given complete pass-through. They're not taxed at all. Exemption, they're not pass-through. Sorry, exemption completely from income, interest, dividend, or capital gains when they are investing into Invits, as opposed to when they are investing in SPVs or assets which are not under Invits in the warehousing space. There is an ambiguity there on whether assets which do not fall under 80IA, which is the infrastructure space, do they get the benefit of the pension fund, or do the HWS and pension fund get the benefit there? I think that's an ambiguous position right now. And it's a little odd because, even sectors like power are not included in that, which seem to be quite, weird. And in addition to that, not just for sovereign wealth funds and pension funds, even for other investors coming from jurisdictions like Singapore and Mauritius, the income is not taxable in India, capital gains especially, since it's a unit of a trust as opposed to a share, which is what is taxable under the Singapore India or Mauritius India tax treaty. And finally, I think recently, a couple of years back, unlisted Invits were also permitted, as opposed to what the original regulation, which provided only for listed Invits, be privately listed or publicly listed. And this has provided or garnered a lot of interest, since these Invits are a lot less regulated. You have a lot more flexibility, say with respect to leveraging at whatever number you want at the Invit level, and other forms of aspects such as not being regulated to the extent of a listed Invit. The disclosure norms are lesser. So to that perspective, from that perspective, I think Invits, especially unlisted Invits, may become quite common here with the entire suite of benefits that are being provided. Ruchir, back to you.
Thank you very much. Thank you very much, Abhinav. And yeah, I think Invits will probably be, the future seemingly. In our discussions with a lot of the annuity investors, that is the sovereign wealth funds or the insurance companies or the pension funds, and even other sort of large investors, the endowments, or the people we call as the patient investors, I think there is significant interest in Invits. And I think it's rather fortunate that unlisted Invits have also been given the same benefit that listed Invits had. When we did the first ever and the only unlisted Invit now, which is the IRB GIC Invit, we had no idea that the same benefits will be given to unlisted Invits. And obviously there are a lot of regularity, there are a lot of regulatory ambiguities right now because the Invit regulations were not really drafted keeping in mind the unlisted Invit regime. And I think as we work through them, we realize that some of the creases can be ironed out. But this is an excellent product for monetizing infrastructure assets. We are seeing significant interest from the investor community. It can be single asset, single investor, pretty much liberalized and deregulated as one may wish it for. So happy to take questions around that. But maybe if we could just now move to asking some of the more commercial questions, and that's what I think, Jaggi, I'm going to ask you, the most important question that I think a lot of our clients want to understand is that how do you see the sort of investor profiling in warehouses, and what sort of capital pools do you think it will attract? Will it be the annuity pool? Because it's ultimately a stabilized asset. So will it be the annuity pools, or will it be sort of the growth capital, considering the underlying land cost is appreciating, and or is it in the nature of any other kind of, let's say, a credit pool, for instance, or a credit asset? So I would love to, hear your views on this. But just before that, very interestingly, long back, there was a client of ours who came and said that, he had invested in several real estate funds and they didn't do so well. And some of the land parcels that he had bought without that much construction performed very well. And he came and discussed and said that, can you please create for me a lazy real estate fund, where I could really, benefit from the tremendous growth or the capital growth that Indian land sort of, the way it appreciates. And I think a lot of foreign investors seem to look at warehousing also as a significant land play. And that's where I think a lot of the capital might also be going, considering that, real estate generally as an asset class has been suffering for a variety of reasons. So Jaggi, just quickly wanted to hear your views on what sort of capital pools do you see that, this sector will attract? And do you think that in a subdued real estate market, the real estate funds will now be gravitated more towards warehousing?
Hi, good afternoon. Thanks, Ruchir, for having me over. A couple of things. I think at the end of the day, the first thing that everyone looks at is obviously return. So I think what's important is that any investor who puts in money would obviously want a return or hurdle that they have actually been wanting in their fund. But when you look at warehousing, typically the kind of money that gets attracted to warehousing is long-term money. So when you look at an investor who's looking for a short-term gain or a short-term investment, he's ideally not the right investor who would actually put money into a warehouse fund or towards so, for example, you have residential and commercial funds which are like 4 years, 5 years. For example, our fund is actually a 10-year fund. So what our belief is that this is long-term money that needs to be committed to warehouse. Warehouse needs to see at least 2 cycles of real estate turns, especially in terms of the rental cycles, to actually get the benefit out of the land. And the reason for that is that when you're buying rural land, you're normally buying it away from the city centers, and when you see the cycles of 4 to 5 year cycles, you get your rent enhancement when actually the rural land becomes closer to the city center. whereby you can actually get a better rental or a yield from where you had actually started off. So a short point to me, it's mainly endowments who look at this space. Funds of funds look at this space. Pension funds look at this space because it is typically, it's patient capital and long-term capital that attracts funds to warehousing. What was your second question,
Okay.
Ruchir? I couldn't hear that actually.
No, I think so. One was the pool of capital, obviously,
Yes.
and the other was the sort of kind of capital. Do you see more equity coming in? Do you see credit? What kind of capital? Or
So,
what kind of fund investor?
So so my view is that I think in the warehousing segment it's going to be equity coming in. It's and the reason for that is that when you had put up the chart of the players in India or the players abroad of who are in the warehousing space, you actually don't find any Indian developer except the Embassy and Warburg joint venture. So what you actually find is that the funds themselves or the fund managers have actually become developers themselves. So in that context, we bring capital ourselves, right? So we really don't need debt debt or last mile funding because we are well capitalized. What I think we need, or the funds that will get attracted to this space, is typically equity. And one of the reasons, the main reason, is that there is no Indian developer in this space, so he doesn't need, I mean, we don't need debt. We are well capitalized. So I think it's going to be equity money that will continue coming into this sector rather than debt or last mile money coming in, is because that's not what our industry needs currently.
So I think just on that point, and before, and then maybe Rajeev, I'll hand it over to you after this, and you can have your questions. But just before that, I think obviously there is one league of very large institutional players, and Matthew's presentation highlighted that, all the big names. But there is also a league of very well-to-do institutionalized domestic players, which are sort of getting or getting orientated towards receiving global capital. We did we did a platform with Scalar or Musadilal, with a fund called Proprium some time back. And that sort of opened our eyes to some of the other grade A developers which could possibly be coming up. How big do you think is that market? Or do you see largely sort of funds like you only fostering some of these players?
Yeah, so like I said, again, there are local players that are there in the market. They are very regional at the moment. None of these players are national level players, though they are looking to expand. But I don't think that they will be able to compete the large institutional players as far as reach is concerned, and even as far as capital is concerned. What you see actually is happening again there. Like I told you, all of us players are by ethos. We are private equity players, right? So we play it's only that because in warehousing space you didn't have Indian developers, that, for example, Indo space, that forced us to become developers ourselves. So we can wear both hats, one as a developer and one as a fund manager. So what you will find is that in the local developers, you will actually find companies like us or institutions like us playing both with them. So we can actually partner with them as developers. We can partner with them as fund managers and give them equity, quasi debt, etc. So I think the play to me will be more us institutional players actually funding the local developers or joining hands with them to grow our portfolio in maybe cities that we aren't there, or cities where we feel that the local player has a better edge than us in certain markets.
That's a good point. Yeah. Rajeev, you want to just come in?
Hi, good afternoon, everyone. And thanks, Ruchir, for having me here. Rajesh, hi, and Vikas, hi. I want to take both of them to a bit of a history And I remember doing the first transaction in the year 2010, and Indospace was here in North India, and you were looking to buy your first land parcel. And I clearly remember the kind of land prices that were prevailing. The unit level economics in the 2010-11 around that time was very different. We were looking at almost a ratio of 1, the rental to the land cost on a per square feet basis. And fast forward to 2019 and just pre-COVID days, when the land prices have increased manifold, almost 2.5 times, 3 times of as compared to 2010, while the rentals have perhaps increased by just 25 to 30%, and therefore the entire ratio, the unit level economics have become extremely lopsided. And this trend is not stopping because there's so much of, Matthew spoke about the number of operators who are coming in. So the land prices clearly are seeing a lot of upward pressure while there's so much of supply that is going to be hit. So I don't see rentals going up. So in this scenario, how do you see the market playing out? What is going to be the key success factors for the incumbents? And I want views from Vikas, because Vikas has a very different acquisition model. His is a more land aggregation model, while Rajesh has a more model where he buys the converted land from the aggregator. So I think both of them can give a very different perspective. So maybe because you go first, and then we can take perspective from Rajesh as well.
Thanks, Rajeev. Thanks, Ruchir. Thanks for having me over. From the historical days of 2010 to today, what has also happened is that while the land prices have increased, maybe twofold, threefold, but the reach has also widened. When I say reach, the center of gravity back in those days used to be something else. So what has also happened is the area under development has actually increased. We were looking at about 30 kilometers, 40 kilometers, 50 kilometers max from the city centers for doing warehousing then. Since those lands have, as you rightly pointed out, have become unaffordable in terms of the pricing going above, probably is an ideal price for doing a warehousing logistics park. So the actual reach has increased, which actually also increase the supply of land. So the challenge will continue to be there. You will have to keep on inventing new areas for warehousing, connectivity improving, areas getting closer to cities would give them more promise for doing warehousing developments. Let's face it, we need to be about 60, 65 kilometers away from city centers to be doing the land under development has also increased. So that, I guess, answer your questions.
Rajesh, you want to bring in slightly different color to this?
Yeah, so I think that Rajeev, I actually fully agree with you. I think that when you look at 2010 and you look at 2020, I think what's happened is that land prices have gone up with more and more players coming in the market. You are seeing a subdued rental. You are seeing with the last 2 years of manufacturing actually not being positive as far as the economy is concerned. You are seeing on the manufacturing side, industrial parks taking a beating as far as the rentals are concerned. I think, so I look at it very differently than Vikas, right? Okay. I think the problem with India is that that is infrastructure going to keep pace with the 65-kilometer radius that Vikas is talking about, right? And whether clients will move to that distance if infrastructure keeps its pace. So I'm really not sure whether in India infrastructure can keep its pace or not. I think from my perspective, and it's completely an Indo-space perspective, unfortunately, is that the way we look at this industry is to play a very dominant player and play a very dominant role. I think for us, what we are doing is we are one of the only pan-India player, and I think the way we are playing this game is it's a long-term game. As I said before, we have long-term capital, and we see for us the returns coming not in the short term. We see returns coming for us in the long term. Okay, and what do you need for that? You need actually rental appreciation. I think you need reach, and number three, you definitely need cap rate compression. And our belief is that in the next 5 to 7 years, we believe all this will happen, and therefore we continue to try to dominate this space and actually be in all locations where there is a need from the client. So I actually look at it very differently. I'm not looking at it from a present perspective. I'm looking at this space from the next 5 to 7 years, and I'm quite confident that if these three factors are actually do get implemented or happen in this country, I think that's where you will make your money. It's not in the short term. But Rajeev, I fully agree with you. Currently, the yields have fallen. Some of the transactions that are happening in this market, I actually quite kind of find myself quite surprised. They make money, but when we view something, we view it from a long-term horizon.
Just as a follow-up question, and Rajesh, you touched upon two very interesting aspects that are going to get played out in the future. One is the pricing, and the second is the cap rate compressions. Which one do you think is going to be a dominant factor? Because there's going to be too much liquidity chasing, and therefore capital compression will happen first, or it's going to be a huge demand upswing, and therefore whatever vacant areas are there that are going to be filled in, and therefore it will start putting pressure on the pricing. Which one do you think is going to be the dominant factor?
So I think it's a very difficult question, and I think so I think the problem is that cap rate compression, when you look at India, over the last 20 years, unfortunately cap rate compression hasn't moved in tandem at the same pace that we think it would move, right? So over the last 20 years, you've seen cap rates move like 300 bips. Okay. And what I'm talking about is that in the next 5 to 7 years, it needs to move about 200 bips. Okay.
Yes.
So that's the difficult part of it. But I just feel the way India is growing as an economy. I think the way the last 2 years we are seeing interest rates coming down slowly, and obviously post-COVID they've come down further. I would want to bet myself on cap rate compression. I am not very confident, on actually trying to go out into new areas and trying to get land at a cheaper price and see whether that works. I would actually try to hope that capital compression happens rather than moving out into areas where it's more difficult to actually get clientele.
Just on that point.
Go on, Ruchir. Go on.
Sorry. No. So I think for that probably we need great demand, and I think just from that perspective, I think there is a clear perception that e-commerce is calm, and Indian warehousing story is gonna go great guns and all that. And while it is growing, and I also have a question here on the same lines from someone from Sapphire Capital who's asking that in a sector that is growing at 20% CAGR, I don't know whether that 20% is true or not. Maybe you guys can guide us. But definitely as an outsider, we see that e-commerce seems to be driving a lot of the interest here. But is there really enough demand, or is it really growing the way we see or the way we expect it to grow, or are we really overestimating the demand somewhere? Or where is the gap? Because somewhere the demand doesn't seem to be that much, or am I incorrect?
Is the question for me?
Anyone? Maybe you can take it, Jaggi.
Yeah. So you know what? So I think that when you actually look at the word warehousing, okay, everyone actually just relates warehousing equals to e-commerce. Okay, but actually that's not the fact, because this industry is divided into two sub buckets. So one is warehousing, which is actually catering to e-commerce, 3PL, etc., and one is actually catering to light industrial. So just, I don't know whether it'll surprise you, but till about a year back, for Indo space, our thrust was more on industrial and light manufacturing than on warehousing. And our portfolio had approximately more than 75% of industrial and light manufacturing and 25% of warehousing, that is e-commerce and 3PL. What obviously has happened is that over the last 2 years, after GST has come in, we have suddenly found a huge amount of demand in the warehousing sector. And also with companies, getting into the mode because of taking advantage of GST, actually rationalizing and bringing efficiency into their supply chain management, whereby there's a huge demand for 3PL. So if you ask me, over the last 2 years, the demand in e-commerce and warehousing has been huge. The industry has grown 25% year on year. Obviously, unfortunately, pre-COVID, post-COVID, I'm not getting into that debate. So we are seeing between a 25% to 30% increase year on year. And I think that the demand is there. So I wouldn't actually say that there is a balloon, but there is 100% demand in e-commerce and in the 3PL space. We continue to be bullish on manufacturing, but for the last 2 years, because of the economic conditions, warehousing has taken a lag. But again, we are hopeful that post-COVID, if India and the government plays it right, we can actually attract a huge number of manufacturing into our country. Auto, electronics, stuff like that, where I believe that there is a huge potential for our country to actually take advantage of.
Ruchir, I have a follow-on question on the e-commerce only, very briefly. And this is to Vikas, and Vikas can perhaps bring in some perspective from the occupier side. The entire e-commerce landscape is getting rewritten in India, and while on one side you have Amazon and Flipkart, the big boys, and then you are seeing entry of JioMart, which again is going to be very big. So clearly there's going to be three of these large players who are going to consolidate the space and therefore are going to be the large occupiers also. Given the size that they are going to operate in, do you think they would have bargaining power when dealing with warehouse operators like you, and this would therefore bring in your prices and therefore return on capital under a lot of pressure?
It's actually going to be a mix of both. So what is going to happen is, to take it up from where Rajesh said, what has actually happened is that if we were to segment the country and we operated only one geography, so the industrial bit of demand has always been more bullish on the western and the southern side of the country. With respect to e-commerce, the bigger consumption areas happens to be North NCR primarily and the areas around it. With Jio coming in, with Amazon coming in, I would rather want to believe that it's actually going to be a mix of both. You would have some bargaining power to the e-commerce companies, which they actually have today as well. Simply the scale of the consumption that they have in terms of warehousing square feet, and also with new fabric of a society changing, wherein having more e-commerce penetration, not just in grade A, but in grade B and grade C cities, where they would want to set up their sort centers or in city. I'm getting into a little bit of technicalities here. When I say in city, I mean, as of now, warehousing has primarily been restricted to outside city big box centers where you do all your warehousing. With e-commerce, two things are happening. A, the actual demand is increasing, since they already have about, let's say, 30 to 35% of the total warehouse consumption in North at least. So they would continue to have that demand, but they're also rewriting the books. What they're also doing is they are pushing people to do bigger city distribution center. When I say in city, you typically move toward the center of gravity inside the city and not outside the city. So you would have more a model where you'll have a mix of everything. These guys will continue to put pressure simply given the weight of consumption that they have in terms of warehousing, but also with supply getting constrained, even with newer areas, you would have, it's going to be a mix and match. It's really difficult to say right now what's going to be the clear story, but it's going to be a mix of both.
All right, Ruchir, over to you.
Yeah, I think I'll just take, we're running short on time, but I'll just take one last question from Avendus. Says that, entry of foreign investors in the space, what structure and strategy will they employ? Now, that's a very wide question, but maybe Jaggi, you can take a shot at it. But maybe my question to you on that point will be, because structure and strategy can be as subjective and as large, but where is the exit? Where is the monetization? Is it the IPO story, or do you think Invits can be possible?
I think that if you look at a warehouse, or you look at commercial, I think that strata sale is something which is not a good model at all to actually kind of go for. So ultimately, what will happen is that when you look, you will have to kind of create a portfolio and then exit that outright. So when we were looking ourselves to actually do an exit of one of our first funds, we actually kind of got into a unstructured private REIT model where we actually had CPPIB, the Canadian pension fund, and actually come and buy that from us for a long-term perspective. So my belief is that from a warehousing perspective, because it's strata sale doesn't make sense. It's not lucrative. It's a long-term game. It's a long-term hold game, and I think that's a very critical point in this asset class. To me, the 2-3 structures that would work is, one is obviously a REIT model, which is a public listed REIT. We have many of them across the world in warehousing and industrial. Obviously, we have a very successful REIT in the commercial space in India. Number 2 is that I'm glad that there is an inventory that's come out, because the thing is that we are at the end fund managers. We are not sponsors, right? So when we have to take out a public REIT, it becomes very difficult for us to get an anchor sponsor, because we've got various investors. So we don't have one investor which can hold more than 25% of that REIT. So I think this model of private REIT, I think, is another alternative. The third alternative is something that we've adopted, which in a concept is a private REIT, but we've got a large pension fund who's actually bought this asset from us, given us the management rights, and they're going to hold it for the long term. Ultimately, I think there are going to be these 3 models that people are going to adopt from a sale perspective. And the only reason is that it's a long-term revenue generating asset which needs to be held for a longer term rather than holding it for the short term to generate the envisaged returns that you want.
So the only twist there may be that REITs, I don't know for what reason, the government doesn't seem to favor the real estate sector. So REITs will always be public listed, and therefore always challenges for foreign sponsors, etc. And therefore, if it's probably unlisted Invits, maybe that's something you could look at. But of course, and then maybe listing the Invits at a later stage.
Yes.
That could be one option.
Absolutely.
Okay, maybe I'll just quickly run over to Kaustuv, and then we will take Q&As. There are a lot of Q&As here, but maybe I'll just quickly run over to Kaustuv for a quick 8-minute to 10-minute presentation on GST issues, which is critical. Kaustuv, can I request you to please run the presentation?
So, Ruchir, I'm sort of aware of the time constraints, so maybe we can skip the presentation and I can just talk through the issues quickly.
You can speak for 10 minutes if you want. That's fine. It's a 75-minute session, so you can speak for 10 minutes.
That should be fine. So quickly speaking, I know that GST has been the harbinger of growth and focus and most efficiencies in the warehousing sector. The legacy principle was that the companies would have a warehouse in each state. That's no longer required, and hence there is increasing focus that we are seeing for companies to consolidate and really respond to warehousing to cater to the markets that there are. So on the issues in itself, The first really point is at the point of creation of the real estate asset. As somebody just mentioned, that the government, from a tax perspective, has not been kind to the real estate sector. There are certain challenges to avail the input tax credit of the setup or the construction expenses that you incur while creating the asset. Of course, if I split up the construction expenses into site preparation and civil works in each stage, then you go on to the construction of the pre-engineered build. You have plant and machinery and equipment, and you have other development as well. So if you split them up, how much of this can you take an input tax credit off? There is a apparent challenge to this in the way the law is framed. There is also a debate on whether this bar on input tax credit that you have should apply to the pre-engineered buildings or not, because they are largely built on a screwdriver technology. They can be moved from site to site. There's actually an informal second-hand market in that as well. So that will help you in deciding what your cost of construction will be, because if you get credit of that, is something which will not form a part of your cost and not something you depreciate over the period of your asset. So that's the key issue that we see being faced now. Interestingly, if I can go to the next slide, the litigation on this issue has already started and reached a large number of states. There's been a positive ruling where the Orissa High Court has said that a company which is creating an asset on payment of GST for earning revenues which are subject to GST as well, the input tax credit on the construction stage, there the case was in the for a mall builder, that input tax credit can be barred, and because if you are compared to a real estate developer or a commercial property developer who's building and then onwards selling, and they are liable to tax on that, you are allowing a full input tax credit on an admitted basis. So barring tax credits in one case and allowing a tax credit in one case is an unfair distinction being created. And hence this has been challenged because this issue applies to the entire segment, whether you're in warehousing, whether you're in hotels, are you in rental of property. Issue is there up and about in all the high courts. It's the issue is pending before Supreme Court, but writs have been filed across a number of high courts in Delhi High Court and the Rajasthan High Court. Some the top real estate players are also in the Punjab and Haryana High Court right now. So we will see an outcome of this in the near future in due course. So moving on to the next slide, we also have an issue which really concerns us from the GST contracting methodology. You need to see at the asset creating stage, are you making a split contracting? Do you have a hybrid contracting, and do you have a turnkey contracting? All this has an impact from the way you treat your project costs once again, because for you to segregate what input tax credit you're getting, which are not going to be depreciated, and what you're not taking a credit, what you are taking a credit on, for which you will need to keep that in your books of accounts as a balance item to burn out over the period of you earning the rental income. That's going to be something which needs to be seen. So this is largely a housekeeping point as to how to best keep your housekeeping neat in terms of what you are taking input tax credit on and what you're not. If we move on to the next item, there are certain issues that we are facing on long-term lease of industrial plots. There's an exemption from GST there when you lease the plot from a government instrumentality. Let's talk about a state industrial development corporation. But the way the exemption is framed, it needs to have a 20 or more ownership of a government, and that ownership is defined as a direct ownership or through a wholly owned subsidiary. We know that the PPP model, which has been adopted, let's take the case of an airport project, there is a 26% shareholding of the government instrumentality there of the entity. So if there is a sublease of that property, we have a question as to whether the GST exemption for the long-term lease of industrial property there will apply or not. Moving on to the next slide, there are some issues that are being faced on how the GST should be treated for lease and a sublease of land, or when there's an transfer of a land of lease, where there's an assignment of a lease from an existing leaseholder, where there's company B is exiting a lease by assigning the lease or making a sublease of an industrial property. The primary lease may have been exempted from tax. It may have been something which has been contracted in the pre-service tax times, which did not attract tax. But the secondary lease which you sign at this stage will attract tax. So, but the challenge we face is that if that lease also has a built-up component to it, how do you treat the built-up component? Because built-up, the sale of a built-up immovable property is not something that's clearly attracts GST. So quickly moving on to the next slide. I think one of the other challenges that we are facing now is situations where there is a company which has an existing property at a particular location, and at the point of exit of the property means that they may have taken the property on lease from an industrial development corporation, but has not really built up a property there in terms of for warehousing or for any industrial purpose they had, and they're looking to exit the property. There is a tripartite agreement which is entered into the state with the State Industrial Development Corporation there, which really in some cases has some characteristics of a novation of contract, where instead of the State Development Corporation actually refunding the upfront lease premium which is paid by the original lessee, actually has a net off mechanism where the new lessee pays the capital component to the old lessee, and they exit the contract, and the lease is effectively still entered with the State Industrial Development Corporation. So what we are seeing is that there's a mixed practice of the exiting party to charge GST on that lease premium which is collected, because there is debate on this issue right now. What we need to note that the lessor and lessee relationship is still between the Industrial Development Corporation and the second lessee who's entering into the contract now. What really happens is that net off mechanism is a way of refunding the premium paid by the original lessee. I think I'm good with that now, Ruchir, and I'm happy to field any questions that are required.
Thank you. Thank you very much. I think just very quickly, I think we have 5 minutes more. Rajeev, do you have any questions? Otherwise, maybe I'll just take some questions from the audience.
I think you open it up for the audience. You just have 5 minutes, so it's better we go to the audience now.
Okay. So I think one question is here that, and I think we probably have space for only one, is that what are the reasons why this, why warehousing hasn't grown despite such demand, such interest? Why have the number of players and the sort of partnership remained pretty much subdued over so many years as well? Because I think it's not very nascent, so to say. It's been a while. Maybe Vikas, you could take a shot at this, and maybe Jaggi. I mean, it still remains the game of the big players, the big offshore funds coming in. Vikas, you want to take a shot at this question?
So my take on this is that it's actually a very capital intensity that is required, or the consumption of capital that is required to do a big logistics park vis-a-vis any other asset class. If you were to do a commercial or let's say a residential project, is very it's inversely proportional, so to speak. I mean, you would not require a lot of capital to do a big platform for warehousing vis-a-vis a platform that you would require for doing a commercial project. So the reason why most of the big players aren't interested are there can be many issues. As I told you, the big one would be the absorption of capital. Then the other one also would be land. One side we have limited capital absorption. The other side we have massive land consolidation. Land being such a touchy subject, when you were to consolidate a land and do a logistics park, let's say in about 100 odd acres, it can take forever. In a country like India, where land is such a touchy subject, for aggregation, any fund for that matter, if you see all the private equity funds operating, the biggest handicap for them also is land. The kilometer population density that we have, and given the consumption of capital that is required for doing a big park, these two are the single most biggest deterrent that I feel for large institutional private equity investors coming in and looking at the space in India and our case.
Okay, I think it's 4:10. We are pretty much done with the session. I think maybe I just had one question. I think Jaggi, if you're there, just one question that I wanted to ask was, I know obviously when you do investment platforms, it's really your own enterprise. But if you were, let's say, Everstone and not really into space, would you be investing at the land aggregation stage before approvals, or will you take the risk of coming before financial closure happens? Or if you were not running the enterprise and you were just purely private equity, or would you really come in once everything is done and then really come in as a private equity investor? I think the question is, how much risk will you take?
So I'll just add to what Vikas said on your last question, just to kind of on the lighter side. Unfortunately, warehousing, unlike hospitality and commercial and residential, isn't an asset class which people want to say how many storage space banai hai. So a lot of Indian developers don't relate to it from a perspective warehouse kaun banayega yaar, sitting in my city in middle of Bombay, who's going to drive 300 kilometers to find land? Yeah, so that's on the lighter side on the webinar. So I think it's not a prestigious asset class, if that's what I want to say at the end of it. From a fund perspective, land aggregation is a very difficult job. It's a very complicated job. And from a fund perspective, we would not take part in the aggregation process. Even if there's an aggregator and we do appoint someone, he would have to complete the entire aggregation process before we do actually come and take a financial exposure. So we as a fund, to be part of an aggregation process, to us is a very risky proposition. Because we found over many years that the success rate in aggregating land is very low, and it's very complicated, and we actually don't want to take that risk from our perspective. I don't know if that answers what you.
Yes, no, it does. I think it very succinctly answers. You couldn't have answered it better. Absolutely. Okay, and that's the reason why, I think the sector hasn't, despite all that growth and excitement, hasn't really seen the scale that it should have. Okay, great. No, thank you very much. Thank you everyone for being there. Thank you, Matthew, for a great panel. Thank you, Abhinav, for that great perspective. A lot of questions on Invit, but I think we'll take them offline. And thank you again, Kaustuv, for the presentation. Rajeev, Rajesh, and Vikas, thank you very much. All right, thank you.